Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm. I'll be your host, and today I'm joined with Doug Hagren. Hey, Doug.
Seems like so long ago we got to talk to each other. Like what, 2 days, 3 days ago. So it's good to see you again, Kirk. I always appreciate it. It's like I see you almost as much as I see my family these days.
I'm your adopted son, Doug.
Well, it's time to start parenting you better then.
Yeah, definitely need some parenting. Didn't take the first time, so good luck.
That's right.
Awesome. Well, let's dive right in. So today's Friday. Happy October 3rd. It is officially October and is officially fourth quarter. And it's interesting because we talked about this last show and how the end of the quarter tends to be a time where things change. It doesn't mean they change, but if they are going to change, it is a high probabilistic time that it will happen. The markets have kind of taken it in stride along with the government shutdown, which it's kind of funny. The markets have actually gone up with the shutdown, so I'm not surprised at that. But either way, I think it's pretty interesting. So lot going on in the world. Like I said, the government shutdown, which curious to see. The markets don't seem to care anymore. They cared the first time it happened, and since then they don't. But I do want to talk about a few things today. We got lots of charts to share, lots of mental models to share on what's going on. I know everyone here has been listening to our rant over the last few weeks over the biggest bull market ever, which is gold and now silver. Even mining stocks are taking off. It's boom time for everyone. So if you're not involved with that, I would highly recommend looking because there's a lot of room to run. I will say that silver is getting really, really close to an all-time high. I think the all-time high was 59.5, I believe. I thought it was 50. I'm sorry. I thought it was 50. It was 49.5 is what I was told the other day. So I have to go back and look. But it is 48 as of right now. So I took some profits off the table the other day because we had a great run. And if it breaks through this 50 barrier, which I'll just call it 50 because 50 is a round number and market likes round numbers. So if it breaks through 50, I'm all in for the, not all in, don't misquote me. I'm all for silver rocketing higher. I do think it needs to consolidate a little bit here at the 50 range before it breaks through. I do like the fact that almost no one's talking about it, except for the meme boards. They've been talking about it for the last like 10 years. But except for them, other people are not really talking about it, which means there's a lot of room to run. And gold's been doing well. Miners are starting to do well. Miners had a great year. I think they're up 100% plus this year. So a lot of the good stuff going on. But I want to dive into this one mental model before we dive into some charts. So two things. First thing is I want to talk about this thing that Doug actually sent, and this is something sent out by Boeing Aerospace, and I have to point this out because it's so wrong in so many different ways. And what this shows is on the left, age of retirement at death. I don't know why that has in there. Age of retirement. So it shows basically 49.5 up to 65.2. And then on the right column, it says average age. And I assume that's at death. I assume that's in the wrong place. So what it's showing here is that if you retire at 65, you're going to die at 66. If you retire at 64, you're going to die at 68. And so on and so forth. But if you retire at 50, you're going to die at 86. Well, this is a bunch of people at Boeing. You'd think, well, this is irrefutable. This is evidence. This is data. It's obviously true that this is the case. Now, at the bottom, I want to read this because it's priceless. Table indicates that people retired at an age of 50, the average lifespan is 86, whereas people retired at 65, the average lifespan is 66.4. And this is highlighted. An important conclusion from this study is that for every year one works beyond the age of 55, one loses 2 years of lifespan on average. Really? Is that the conclusion that you come to? Um, that's what the data shows, but their conclusion is bunk. I'm sorry, I got to say it. I got to swear, it's bunk. Your conclusion is that people should retire early because they're going to live longer. There's so many things wrong with this, but I'm just going to point a few of them out. One is that the only conclusion, or are there others? Because I can guarantee you I can come up with at least 10 right now that are completely different. One of which is the average lifespan of a whistleblower is a lot lower than this at Boeing, but I won't get into that. So if you look at this conclusion, right, at the age of 50, you're dying at 86. Well, if you're retiring at 50, first of all, you probably have enough wealth built up that you probably have means, and people of means tend to live longer. That is another conclusion, quote unquote conclusion, that you can come to this, is they probably had enough money, so they might live longer. People who are wealthier tend to live longer because they have means and they have access, and they have access to good doctors, they have access to stuff that most people don't. They're not grinding themselves to the bone every single day, so they don't have as much stress. There's a bunch of conclusions here that you could come to. The least of which is that every year shrinks your lifespan. So I point this out because I want every single person to be very aware of, I guess you call it fake news. This wasn't in the news. This is released by Boeing. But this is what we call a false conclusion, right? This is where somebody takes some data and comes to a conclusion and says, this is the truth. No, it's not the truth. It is a potential truth. I would argue it's not, because there's so many other things that go into this, that age is the least of the factors. Age is a factor, of course, but I would not hang my hat on age is the determinant here. It could be what people retired 50. Are they the CEOs? People retired 65. Are they the factory workers? That makes a difference. There's so many different things in here that could affect the outcome that you cannot draw a conclusion, according to this, an important conclusion. You can't draw a conclusion just based on age. You can draw a correlation. That would be a better word. An important correlation from this study would be the better way to describe it, but they use the word conclusion. It's not a conclusion, it's a correlation. Yes, it is an important correlation. I would agree with that, but that's not what they said. And you could look into this and say, all right, let's look into the data. Now, I heard this on a podcast a few weeks ago, and I thought it was one of the best frameworks I've heard in a long time. And what he said was, all data is fake. All data is fake. Now, you're probably looking at that and you're thinking, obviously, that's not true. Think about it. All data is fake. Is there any set of data, large data set, that you could say this is irrefutably true? I look at the news every single day and I see headlines that are BS. And it's based on a study, or more accurately, a meta study, which isn't really a study. It's basically just somebody's narrative. But if you look at all the stuff we get, how much of it's actually true? Look at global warming or climate change or whatever they're calling it. I guess they're not calling it anything today. But back when they were calling it something, the data, the science is proven. Really? Is it proven? I mean, well, all the scientists say the same thing. Yeah, they also said the Earth was the center of the universe at one point. That turned out to not be true. What did it take? It took one person. It took one person to disprove every single other person that was said to be true. That's how science works. Science works because you have one person who disproves it. All you need is one. You don't need 100. 100 is what we call propaganda. Oh, there's 100 people, so it must be true. If one person says it's not, and you can repeat the study, then everybody else is inaccurate. That's how science works, right? Science works. And that's why, although I heard today that Copernicus did not discover the heliocentric galaxy, supposedly it was a guy way before that. But anyway, Copernicus, against everybody else, said, no, the Earth's not the center, the sun is. Oh, okay. And of course, they didn't like that, and everybody kind of went after him. But it was eventually proven to be true. So I want you to think about the framework that all data is fake, right? It's a framework, it's a mental model. So when you look at data, you should look at it, well, what's fake about this? Now, I'm not saying I'm 100% accurate. I'm saying this is a mental model, right? This is a mental model on how to think about the world. All data is fake. Okay. Does that mean you should throw out all the data? No. Does it mean you should rely on 100%? No. It means you should look at it with a critical eye and say, okay, just like we're looking at these numbers. Okay, well, there's an obvious conclusion you can draw from this. No, it is a correlation. There's also a correlation that that people die. That's another correlation. Well, everybody here's dead. Okay, yeah, that's a good correlation. Is it a conclusion? Probably, but my point is you're looking at a data set that is data is not truth. It's data. What you conclude or correlate from the data. So any sort of science looks at data sets and it comes to a conclusion. And if people can't refute the conclusion, then it ends up being a theory, technically, or a law. They don't really come up with laws anymore, but theory. So it's not quote unquote fact, but it's as close to fact as you can get in science until somebody else disproves it later, right? Like Einstein, people haven't disproven Einstein. Maybe someday they will. Maybe he's wrong. I don't know. But you can't accept things as quote unquote truth. There's just a current truth of what's acceptable now, but it doesn't mean it can't be disproven. So I just wanted to give that framework because it applies to everything. It applies to science, especially because science is made up of a lot of data. But the financial industry is also made up a lot of data. We see this every day. Doug and I are drowning in data. I see data all the time. I come up with my own theories about it. I don't know if it's true, but I know in the back of my mind, I don't know if it's true. But it feels true enough for me to make a direction. So, for example, if you look at silver, as most people do, I've followed silver my whole career. I love silver. I think it's a great asset. But you hear a lot of theories. One theory is they're not making enough of it. They're manipulating the silver price. It's the bankers. They're manipulating the silver price. Okay, why? Why are they manipulating the silver price? Do you know? Have they stated it? Or are you mind reading? Now, everyone's got this theory. Well, the bankers are keeping the price down because they're keeping gold down and inflation, blah, 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 blah. Okay. I don't know if that's true. I mean, I agree directionally that could be the case, but I don't know for a fact. Nobody's come out and said, here's what we're doing, here's why we're doing it. No, you're mind reading. We all do this. The media mind reads all the time. Well, Trump's thinking this. This is what Trump's going to do. Did he say that? If he didn't say it, then how do you know? You're just making stuff up, which is why people don't watch the mainstream media anymore, because they just make stuff up. It's all opinion. So when you're looking at stuff like this and you're coming up with theories and conclusions and correlations, coming up with the reason why silver's not higher, it doesn't matter. It doesn't matter. Why is silver depressed? Doesn't matter. Because you're never going to know. Why did gold drop in April 15th of 2011? Why did it drop like significantly? I heard 20 different reasons. None of them are accurate. They all came from the media, which they just looked at gold price and came up with a theory. They didn't do any research. I can tell you for a fact, I followed it very closely. No one knows why it happened, but it happened. Who cares why it happened? It happened. That's what you need to know. It happened, right? Why did the 87 crash happen? Doesn't matter. It happened, right? That's what you need to know, is that it happened. So it doesn't matter why. Why is not going to make you sleep at night. Actually, it will, because we all internally need to know why. But it's not going to help your portfolio. So if you're looking at investing right now, if you're looking at silver, for example, why is it starting to take off? Doesn't matter. It is. And yes, fundamentally, it should be a lot higher. It should have been a lot higher for a long time. Silver hasn't broken its all-time highs. And gold's been way above it. I forget what gold's. Gold's like twice what it is, twice all-time highs. Silver's got a long way to go. Proportionally, ratio-wise, I don't know this for a fact, but theoretically it should, right? That's if you think of everything as reversion to the mean, that's what should happen. Same thing with miners. If gold's up 100% and miners are up 20, that's not normal. The miners will eventually have to catch up because that's how economics works. Just because they haven't doesn't mean they won't. Now, my theory is they'll catch up. Does it mean they will? No, it doesn't mean that. I mean, eventually they will because it has to. It's just the way things work. But the point is if you want to know why doesn't really matter. What you need to know is that it is happening. So is gold taking off? Absolutely. Is silver taking off? Yes. Is miners taking off? Absolutely. Where are they going to stop? Why are they going to stop? Who cares? Don't spin your wheels on that. Look at the price, make a determination of what risk you're willing to take, what returns you're shooting for, what's your target. My target on silver has always been 50. Do I think it's going to break through? Yes, I do. But the first target is 50. It came close to that a few days ago. We lightened our positions because I was like, all right, we're getting close. It doesn't need to be perfect, but it's getting close. So I took some profits off the table. I'm sitting on the sidelines. Once it breaks that 50 range, I'm getting back in. If it drops a lot, I'll get back in. But we're hitting a resistance level. I know it's there, and I'm not going to freak out about it. I'm not going to get greedy. Made some good money, but it's like I'm not going to get greedy. Take it off. And yes, I know it should go a lot higher. It should be up to like 200 or 300 or whatever it should go to, or whatever quote unquote should go to according to people. I don't know where it's going to go. I know it should be a lot higher, but maybe it doesn't. Just like in the last 20 years, it hasn't done what people think it's going to do. That's okay. Right? There's enough money on the table to make. So don't get caught up in all of the minutia. That's not what makes you money. Why doesn't make you money? Why helps you sleep at night. It gives your brain some ease that there's a rational reason for things, but it doesn't make you money. So don't spin your wheels about why. Focus on the price, focus on the technicals, focus on the important stuff. Where are all the sellers hanging out? Where are the buyers hanging out? So the sellers hang out at resistance, the buyers hang out at support. So if a stock goes down to support, the buyers come in and buy it. If the price goes up to resistance, the sellers sell, and that puts it back down. So that's what you need to know. You need to know those levels. So anyway, I just want to say that because we're at a time where people are making a lot of money in precious metals, and we've been talking about it for weeks, and hopefully you are too, because a lot of money is still on the table in that sector. There's a lot of other sectors. I do want to talk about one. I want to pivot here to a different one really quickly because Doug and I talked about this, and we thoroughly want to beat on a rented mule here, and that rented mule is private equity. Now, we haven't talked about this enough in the show, but I have a bone to pick with private equity. I'm going to keep mine brief because I know Doug's got a lot to say. Private equity, if you don't know what it is, it's basically companies come in. It's like forever been considered the smartest people in the room. The smartest people in finance go to private equity. Mitt Romney, who's like a centimillionaire. I don't know how wealthy he is, but at least a centimillionaire, at least when he was ranked for president. It was over like 106 million net worth. That guy made all his money in private equity, as far as I know. You can make a lot of money in private equity. However, private equity is also, they had that image back in 2008 of like Goldman Sachs being the octopus, like just sucking the life out of everything. Private equity is that. They suck the life out of industries. They come in, they leverage it up, they take out their dividends, and then they sell it and they try to make more money and they move on. It's not all bad, but I know a lot of people in private equity, and I can tell you for at least the last 10 years, seven to 10 years, I forget exactly when, they're not looking to invest in their own stuff because it's so overvalued, it's so overpriced, they want no part of it. So that being said, if that's the case and they don't want any part of their own cooking, why would you want to buy it? Now, I just read a piece from a guy who used to work for, he used to work at Ray Dalio's company. I'm just having a brain fart this morning. But Bridgewater. I don't know why I couldn't think of that. Anyway, so here's a clip of what he said. And by the way, we've had Dan Rasmussen on the show a lot, so he's a great friend of the show. So here's what he wrote. Today, private equity is in the early stages of a major meltdown. Whisperings began last fall, and now the mainstream financial press is picking up on just how bad it's gotten. This article in Bloomberg paints the picture. Distributions are way down, returns are lagging public markets, fundraising is collapsing, and from what we hear, the picture at the portfolio company level is dire, with the majority of companies cash flow negative after debt service. Now, basically, private equity is taking good companies and leveraging them up and selling them off and basically instantly trying to get cash. There's nothing wrong with the model. The problem is it destroys a lot of businesses, and we'll get into that in a second. I'll let Doug talk. The one thing I want to bring this up is I've been hearing about this for a long time, and everyone's like, "Oh, private equity is great." They just try to pass a new law that says, "Hey, we can do private equity in 401ks." Worst thing ever, because there's not enough rich people to invest in private equity, and the smart ones they got out a few years ago. Actually, there was a big run for the door in 2022. Not enough rich people to put money in, so now they're going after the Joe and Susie Public's 401k. If you want to lose money quick, put it in private equity. Are there good deals? Absolutely. Should most people do it? Absolutely not. That's just the truth. You can do whatever you want. I'm not telling you what to do, but I'm not touching it. I think there are good deals, for sure, but you're not going to get access to them. That's the truth. If you have $100 million, you might get access. If you've got 100 grand, you are not getting access to the good deals. So I know you want to. I know you do. Everyone does. I get calls every day. Hey, can you get me access? No, I can't, because you don't have enough money. That's the way these deals work. The good stuff goes to the smart and the wealthy people, and everyone else gets the crap. So don't buy the crap. Do your research. Just wait. Wait for a meltdown. You can buy good stuff after a meltdown. I wouldn't buy it now. This is a public service announcement. Have you ever played the lottery? My state advertises that you can't win if you don't play. What they don't tell you is that the lottery is a tax on people who are bad at math. How many lottery winners have you met? Probably none. If you don't like your chances of winning the state lottery, you're definitely not going to like the chances of winning the inflationary lottery. The inflationary lottery? That's right. Your chances to win the state lottery might be 1 million to 1. But you're guaranteed to win the inflation lottery because it affects everyone. And the prizes stink. But here's what you're going to win. Higher prices at the store, shrinkflation in your packaged goods. Higher heating prices to heat your home. Who doesn't want to win that lottery? Much like the government, I feel bad that your costs are rising. So I want to help you out by giving you some free money. It's not a lot. It's only 1 million Zim dollars, but it's something. Well, you can't buy anything with it, but it does look good as wallpaper. And if you live in Europe, you might even be able to use it to heat your home this winter. If the lottery is a tax on people who are bad at math, then inflation is a tax on people who are bad at economics. I want my listeners to be better at economics. So I'm giving my loyal listeners free money. Go to www.moneytreepodcast.com/free money. Follow the instructions to get your free money today. I have a large audience and a limited number of these currencies. So let's make sure we get yours before we run out. Go to www.moneytreepodcast.com/free money. Follow the instructions and get your free money today. Go ahead, Doug. I know you got a lot to say about this.
Yeah, no, I mean, I think you touched on something really important, is that it goes back to the movie, or the movie, The Smartest People in the Room. I think it was called. Is that what it's called? Yeah, Smartest People in the Room. Enron. There is a lot of really, really. I mean, why do so many people that are the top performers in colleges, universities, get selected to go into private equity? Because what they're looking for is think tanks of ideas, and think tanks of ideas of ways in which you could take a dollar and carve it in 1,000 different ways. And what is private equity? Private equity is, in its idealized model, something that allows for the raising of capital from limited partners, whether it's pension funds, endowments, wealthy offices. They use that capital to buy controlling stakes in company. Again, it's capitalism. Awesome. It's not easy to go out and buy companies. So if you can raise this money and be able to take over companies and that already have great reputations, then again, in the room on paper sounds great, but they typically then will then approach this with a leverage buyout. Now, again, ideally, after acquisition, they aim to improve the operational performance. That's what they want to do. They want to cut costs, drive efficiencies, restructure, sometimes consolidate acquisitions, reposition the business. Again, all sounds great. And then ideally, after a few years, say 3 to 7, they exit, selling to another buyer, doing an IPO, selling the company, or as Gordon Gekko would love to do, its parts. The gains then would go back to to the limited partnership after paying fees. So the value creation, in theory, is active ownership and operational improvement, because the company is private. They don't need quarterly reports to the public markets. They can, in theory, make these longer horizon moves and focus on strategic restructuring rather than these constant short-term stock price optics that a lot of public companies especially are facing. A lot of public companies have talked about going back private and taking themselves back private. You've got this external force now that is coming in to do that. And again, it sounds great. But here's the real problems that have been caused, and the major criticisms. That leverage that they use, it has often been excessive. These hard truths and critiques have piled up. It's not just bad apples, but when you start to apply these ideas, there become structural feature issues. PE deals load these acquired companies with debt. The business slows or interest rates rise. Bam, company can struggle to default. Jo-Ann Fabrics or Jo-Ann, etc., whatever they named their company, was an extremely well-run, profitable company. All of a sudden, within a number of years, they are bankrupt. Another restaurant chain, Red Lobster, again, was actually one of the fairly well-run restaurants that had, loyal clientele. Private equity created this vertical structure, buying from their own shrimp farms, allowing them to basically set those prices. They saddle the company in debt. Now it's turning around now. It's one of those that might actually be a success story after they've gotten rid of private equity, because the loyalty that's there. But many of these firms are essentially betting on these favorable macro conditions, which Kirk and I have just spent time talking about. There is so many uncertainties, even with the best data out there, that can create issues with heavy structural leverage that amplifies downside risk. And if that company fails, employees, creditors, local communities, they are the ones that get left absorbing the losses. And the PE firm walks away or renegotiates. Oftentimes, they've already taken all their money back out through the debt and the interest on that debt that they've saddled it with. So they're going to get their money first. On top of management fees, could be 2% of assets. Carried interest could be 20% of profits if they get profits. And on paper, a lot of those companies are profitable until the debt load becomes too much. And that structure incentivizes more capital raising, not necessarily deploying it well. It is a very short-term thinking. Asset gathering pressure, sometimes incentive to deploy capital or make deals to keep the money moving if the returns are marginal. There is a lack of transparency or secrecy. These are private. They're not subject to the same disclosure rules. Limited public oversight and accountability, and so many of the negative outcomes end up with layoffs, cost cutting, hidden risk. They stay hidden until journalists dig in. There's this veil of secrecy that helps shield these problems until it's too late. As I mentioned, there's short-termism, asset stripping. The cost cutting on paper. If you're trying to build a business, it's a great thing to think about cutting costs. It's a great thing to have financial engineering, but if you prioritize cost cutting over producing a great product and building a better brand, if you have aggressive financial engineering, dividends, loading debt, splitting assets, again, you're going to strip all the value away, sell all the real estate, intellectual property. Next thing you know, the remainder's weaker. Think a great one is Sears. I mean, think of all the incredible brands like Craftsman that Sears had. And then when private equity took over, they just started selling these pieces off and left it as a debt-riddled shell that people still reminisce about. What an incredible company. I mean, I think some of these memes that come through, it's like, which company would you want back? It's hard for me to not say I wouldn't want Sears back. Sears is probably the greatest retail store, in my opinion, that there ever was. In terms of not only what it's, selling other products, but the creation of really high quality in-house brands. And yet private equity turned it into a disaster. So now you've got social and human costs, bankruptcy, exit challenges, declining IPOs, concentration of power and political risk. And you mentioned some, they won't invest in themselves. Some people, they don't show the same operational discipline that they demand of portfolio companies. You got this fee model that there's sometimes a drift away from core competence, the pressure to grow AUM, sometimes at the expense of selectivity and performance. Deals are made for deal flow or put capital to work rather than based on strong conviction. And the internal alignment sometimes frays. General partners have incentives to maximize fees or carry. The LPs may be squeezed. The middle layers of the firm may have soft targets. So what's happening is there's been so many disastrous stories that have now come to light. Public perception is starting to turn against it. You've seen a high visibility of abuses. Again, we face this. One of the worst is in medical area. I know plenty of doctors that work for PE saddled hospitals. And again, it ends up becoming ends up just wearing out the doctors and the staff there. It also means that the care goes down. Nursing homes, retail chains, especially when you've got companies that are really supposed to create better lives for their customers, it can really be a conflict of interest in how it becomes down to the dollar. And now that's made these blowbacks visible. Public and media are saying PE ruined my hospital. PE cut my local jobs. That starts to build up. And now the public's going to look at universities, public institutions, and communities as sacred. When they see selling the future to private equity, now you've got a resistance, especially in education, infrastructure, sports, which I'm going to come back to and finish up on. There's a lack of alignment with public values. It often, these cost cuttings, they clash with broader social mission goals like service and stability. They're asking for more transparency now, which is conflict against private equity. Reporters, watchdogs, and again, we talked about the spurious correlation of longevity at Boeing. By the way, eating more margin. I think or more. Annual. Gold price of gold has gone up with household spending on fresh fruits. There's a great correlation there. It just tells you something about way they look at these things. Ultimately, you're getting more hitting deals are getting exposed, and that puts more return under pressure when performance slumps. Pushback from institutional investors. Pension funds, endowments, and LPs are starting to question the overcommitment to PE, especially when the return lag or the capital's locked. And then you're starting to look at political and regulatory risk. I want to jump ahead to one thing that's now come into the media recently, and that you're starting another one that I think we've talked a little bit in some other conversations about the state of sports. I love sports. I'm an Ohio State fan. I'm from Columbus, Ohio. So it's one of the biggest names in sports, pro or amateur, and not anymore. But with NIL and the money that is not only the money that the NCAA was making and the money that schools bring in from football and basketball and the deployment of that money to all of their other athletic programs. And of course, how does that get tied back into an overabundance of focus on sports and revenue producing there versus academics? But now that we've got NIL, we've got players being paid, and we've got a redirection of the donations that were spread amongst all these activities that now are being donated to NIL funds and going straight to the pockets of players. Again, I'm not saying I'm for or against it. These players certainly earn it. Now, all of the news around this over the last 12 to 18 months, or let's say maybe 12 to 36 months as NILs come in, there's a new one that's come out there. They are now looking at the Big Ten just hit the news of potentially selling its part of its rights and its ownership to private capital. The Big Ten Conference has talked about it. It was really kind of under the radar, but it's now come to light. They've been facing funding pressures. And that's what happens a lot of times. You have a long-term business owner who wants to get out. Private equity offers the top dollar. Sounds lucrative. I can get out and walk away. I get this influx of short-term cash. Right now, these universities, these institutions, these conferences, they need this capital. They are stretched thin, trying to basically barter without a collective bargaining agreement that the NFL has to pay these players and keep them around. So they're considering transforming future revenue streams like media rights into upfront cash. They're going to sell away the future. Inviting private equity capital into a fundamentally public or mission-driven domain means now they're going to be facing mixing profit motives with public goods. You risk that overwhelming the mission. The private investors are likely going to, even though they come in saying, no, we're going to let you run these things. And, Warren Buffett does that. Very good job. I buy you, just keep running your company. Most of these private equities do not run it that way. They're going to likely demand control, clauses, governance levers that may conflict with athletic values, academic integrity, revenue sharing, and ultimately what is the fundamental basis of our university system, whether you agree with its mandate or not these days. And if that private investor fails or wants to extract value aggressively, the institution is stuck. This could not only destroy the sports, but it could come back to creating a scenario in which you could absolutely, especially a tax-supported revenue stream. Most of these schools that are like in the Big Ten, they are public schools. That means there's taxes. And you are now looking at private equity getting into something which taxpayers could potentially be faced with, like selling off your seed corn. You get the cash now, but you lose the optionality and the control of your core future revenue base. This is potentially extremely disastrous for the sports and for these institutions. And it really creates one last thing, a massive potential cultural and academic distortion, which has already been something that all these universities that are supposed to be about academics first have been facing.
Yeah, I couldn't agree more, Doug. I don't know there's a simple answer to all this, but I think a lot of things in our economy, in our society, actually, get ruined because people don't have a set of values that underpin everything, right? If you have a set of values, which is I don't steal from people, then people don't steal. But if the set of values isn't there and you have a chance to steal, then you do it, right? Because why not? Like Wall Street does it from people every day. That's just the nature. It's always been that way. And I think, when people accept that as a culture, they're willing to accept unethical behavior, then stuff happens, right? So if you're willing to accept, like, hey, profit at all cost, and there are no values surrounding that, then you get what's probably going to happen. I agree with Doug. I see it happening. I see it coming. I don't think that we should penalize the players. I do think colleges are getting a little handsy. I think that, frankly, one solution to a lot of our problems is start taxing the colleges. Why are they not paying taxes? That's what I want to know. They're a nonprofit. Any nonprofit of a certain size should say they should pay taxes like everyone else. They're basically a tax-free hedge fund. Most of these colleges. That's all they are, is a tax-free hedge fund. It's stupid. Make them pay taxes. They've got money. They don't need $50 bazillion sitting there in a fund that they can do whatever they want with and indoctrinate the youth. Like, make them pay taxes, right? It's a business. They've made it a business. It used to be the news was a loss leader, right? Everyone wants the news because that's how you get your information, but it never made any money. Once it started making money, it destroyed what it was. I'm not saying it was always perfect, but it's gotten a lot worse. And so I think when you have these carve outs, it tends to create malincentives, which is what we have now in colleges. And I don't, I've been saying this for the last 20 years. You should tax colleges. You absolutely should tax them. Now, if there are nonprofits below a certain amount, I don't know what that number is because I haven't studied it well enough. Maybe like 10 million or whatever. Like if you have more than 10 million in a nonprofit, then you should be taxed. Like I don't know what that number is, but it's somewhere in there, 10, 20 million. If you have 100 million, you should be taxed, right? If you have $1 billion, you should 100% be taxed because, like all that money just sitting there. Oh, I've got $1 billion. Well, I can take a deduction by giving to them, and then the federal government doesn't get the tax. You want to know why the rich people don't pay their taxes? Because they've got all these loopholes that Doug and I don't have, and you and all the listeners here, we don't have these. because we don't have enough money. Well, I mean, we have them, but it doesn't impact us the same way as it impacts them. So you want to know why they're not paying taxes? It's because our system incentivizes it. So get rid of the incentive. Get rid of the charitable contributions. Get rid of nonprofits that don't pay any taxes. Make them pay taxes. So anyway, that's a long rabbit hole.
Kirk, can I just
Yeah, go
add
ahead.
one quick thing? And I think this is the biggest thing that really comes down to play is there's a generational regret problem that comes from these types of decisions, right? Of like, trading potential long-term sovereignty and wealth for short-term cash temporary relief, which you're seeing a lot of, letting this private capital into the bloodstream of public mission institution. You can't flush it out. It metastasizes. It's not a year or two. These contracts are often 20 to 30 year plus commitments. The leaders who sign the deals, boom, long gone often by the time the damage shows up. Students, athletes, fans, future administrators are trapped. We've seen it. Chicago sold away its parking rights to private equity. It is still suffering. And I believe that, especially if we're going to narrow it down to this, what the Big Ten is looking at, but a lot of these decisions in terms of private equity, the disaster is not one big blow up. It's a slow erosion of control, culture, competitiveness. It leaves a weaker, more financialized, entity that no longer resembles what it was supposed to be, and it is often remembered as one of the many short-term greedy choices that permanently weaken an institution.
Yeah. No, I totally agree. All right, let's dive into some other stuff because we could probably politically rant for a long time on this. There's a lot wrong in the world. We're not going to fix it today. So let's dive into a bunch of charts. I had a bunch that I found. So I want to go over a few. I'm not going to stay long in each, but I just want to share just kind of sentiments for the market because I know people are wondering, is it going to crash? Is it going to crash? All right, let's look at some charts. So the first one is sector strength and the S&P. So this shows sector strength. And if you look at this, it's high right now, which is good. That's a good thing versus the S&P. So you can take these correlations, see when it's low, the market tends to be in a dip. When it's high, it tends to be, going up. So, the one thing is, well, it's high, it's just going to drop. No, not necessarily. Sometimes it stays high. So you just want to keep that in mind. This is just showing different lenses on the investment world. Next one is showing the NYSE and NASDAQ 52-week highs. So this is an important thing to look at because when you start seeing a lot of new lows, that's a bad sign, right? When you start seeing new lows and they tend to perpetuate like 2022, that's a bad sign. You want to get out. When there's a lot of new highs, you want to get in. That means the market's strong, right? A lot of companies are having new highs. So you want to look for these sentiments. And when there's times when there's not much going on, then you want to be a little careful, right? But you want to see what we're seeing now, which is a lot of new highs, which means the market is very strong. Let's see. I won't spend any time. This is a similar thing. All right. Here's another one to look at is breath. Not your breath, Doug. I know you brushed your teeth this morning, but market breath.
Kind of fog up the mic here.
The mic just stopped working. All right. So global breath. So breath is basically, if you think of the stock market, let's say there's 1,000 stocks. We have the Mag 7, which have been dragging performance higher for quite some time. That's 7 stocks producing like 30, 40% of the gains. That's not healthy. Now, when you have most of the stocks producing the upside, that is healthy. So breadth is it's not concentration. So concentration is when you got like 7 stocks driving it all, and wide breadth means you have like, 700 out of 1,000 stocks going higher. That is healthy. That's a healthy market. That's a healthy economy. It means that money's coming in. It means that people are, their companies are growing. People are spending money. All good things. So you want to see a breadth that's high. You want to see it in the green area, or at least close to the green. 68% is pretty darn good. Next is a bull behavior indicator. Won't spend any time with that. Blah, blah. Okay. So here's something I pulled from somebody else, and I don't remember who it was, but so apologies to them. But bull market behavior checklist. So if you're an investor, it's good to have checklists and frameworks. I know basically nobody does. They look at the stock price, say, it's going up, we're going to buy more, or it's going up, I'm going to go buy it. It's going down, I'm going to sell it. and people just kind of run around like their hair's on fire, right? If you go to the casino, you know those people, they just sitting there, they're just lighting cash on fire. Then you got the smart ones who are doing things as a part of a system. Now, not all systems work, but there are some that do in casinos, and those people sitting there run the system. It works. It's been proven to work. They may not like it, they may kick you out, but it's proven to work. So there are systems, and the same works for finance. Once you start seeing the successful systems, you start putting together checklists or formulas, right? It doesn't mean they're true all the time, but it helps. So here's one. Here's a bull market behavior checklist. Here's how you figure out if you're in a bull market. And this is the ones they've listed. The weekly new highs minus new lows are greater than zero, which means 50% or more, greater than 50% stocks are having new highs. You will have a greater than zero. Yes, we have that. Net new highs in the advanced decline line is rising. That's bullish. Percentage of global markets above their 50-day moving average, more than 70%. No, we don't. Okay, that's not bull market behavior. The ACWI long-term trend is rising. That's bullish. The S&P 500 200-day moving average is rising. Yes, that's bullish. And the value line geometric index long-term trend is rising. Nope, it's falling. Okay, so out of the 6 indicators, 4 of them are bullish. Okay, that's good. How many times are you going to get them when they're all bullish? Well, not many, because U.S. versus international is not the same thing. There's a lot of things that can contradict. But overall, this seems like it's a bullish trend. That's a good thing, right? You want to look for that. Here's U.S. equity sentiment. This is what the investors' sentiment is. Right now, it's actually a little bearish, which has been kind of weird. So if you look at all of 2025, basically sentiment has been bearish.
I mean, we're sitting in more cash, like gobs of cash. People are still very concerned, even with all the data.
People think the market's going to crash, and maybe it will. I don't know. Nobody does. But if you're sitting in cash, you missed a phenomenal year. Okay, the market's up like 15%. The S&P is. Gold mining stocks are up 100%. Precious metals are up 30 to 100%, depending on what you're in. It is booming for a lot of sectors. Tech is starting to come back. International markets are doing great. Europe's up like 24%. Emerging markets are up. Like everything's up in the world. Like virtually everything's up. Everything's doing great. And investors are bearish. Now, logically, being bearish is the most intellectually sound position. It always is. Always. No matter what market it is, it's always the intellectually sound position. But it's also frequently the most wrong. The markets go up 70% of the time. If they're going up 70% of the time, that means that you're wrong if you're bearish. So you just have to be careful. Now, fear and greed, this is put out by CNN, which means I don't trust it because I know how they create this. This is a fear and greed index, and right now it's at neutral. Now, I just want to say this because there's a lot of indicators out there, and people say, "Oh, it's neutral." Yeah. How did they create that? That is not an indicator. That is something that CNN constructed. Now, I have nothing against. Well, I have a lot against CNN, but I don't have anything against that specifically. Basically, what they did is they created this indicator based on a bunch of data that they decided was true. Do you know what that is? No, you don't. I don't either. I can look it up. I think it's on their site somewhere. But the fact is it's not done by an economist or an investor. It's done by some reporter at CNN that doesn't know probably squat about economics. So I always look at those with a grain of salt and say, all right, interesting, move on. All right, so back to some real indicators. Keep this tight. This is the bulls and bears, the AAII bull and bear spread. It's slightly bullish. Here's back what Doug was talking about, the gold-silver ratio. We won't get into that. We'll get into that later. But, it was really high recently where the gold-to-silver ratio was at its close to its all-time high, close to. Let's see. Here's another one, global M2 versus Bitcoin. So this is a correlation, gold and Bitcoin. Obviously, it matches itself pretty well up until recently. But there's something missing. What's wrong with this? Oh, yeah, it's only 2 years. This is a chart crime, okay? I'm not saying that there's no correlation here. Obviously, there is. Um, but this is a chart crime. You're going back to, I'm sorry, it's 3 years. 3 years of data that says there's correlation.
No, it's 2 years, Kirk. You're correct.
Is it two?
23 to
24.
25.
Oh, yeah, yeah. Sorry, it is 2 years. Yeah, I was correct. Okay.
Yeah. Yeah, it makes you wonder what was happening
I
before
don't know because they
23.
didn't chart it, but I think it's an interesting narrative that they're pushing. So anyway, it's anytime you see these, you always got to look at the data and say, what am I missing? Because there's always something. This is why I say all data is fake. Here's an interesting one. Okay, you're probably seeing this a lot. This is why I brought it up. Here's a overlay of the S&P 500 versus the CBOE VIX, and these are the historical averages and seasonalities. So it's not what it is exactly, it's just seasonally how it operates. So January to June typically is strong for the S&P. From June, July up until like November, it's typically flat, and then November until whatever until the next year are really strong. Seasonally, the VIX typically goes up in the first quarter. It typically goes down Q3, Q2, and Q3. I'm sorry, in Q2, and then it goes up in Q3 and part of Q4, and then it goes down. So this should invert, right? When it goes down, it means that risk is off and people are in the markets and making money. When it goes up, it means risk is on and people should be out of the markets. The VIX is basically the volatility index. So it means the market's more volatile. Volatility typically means the market's going down. It doesn't necessarily. Sometimes it goes up. Sometimes it doesn't correlate. But for the most part, it's correlative, not 100%. It's like maybe 95, 90%. So if the market crashes, the VIX should spike. It doesn't always. I've seen times where it doesn't, which is weird, but it should.
Well, and by the way, I just want to add, this is a perfect example of how you can go by the averages, but they don't always play because this year is not reflecting hardly any of that chart. It's
Right.
actually been a fantastic run in the market and a very temperate time between August and
Yeah.
now.
And so you just look at these for templates. You look at these for, oh, isn't that interesting? If I'm looking at presidential cycles, which are pretty interesting, if you look at annual seasonality, that's interesting. Would I make my investment decisions on it? Absolutely not. Now, I don't particularly like September and October. I think they're rough months in the market. If you're going to have a crash, they typically happen during those times. So I tend to be a little bit
Generally
cautious.
so.
I also tend to be cautious around February, March, because if we had a strong run, there tends to be a little bit of a pullback in there for one reason or another. So it's not that you just jump out of a window. You just say, all right, maybe I should just be more mindful of what's going on and be a little bit more observant and not just set it and forget it. But that's just how to think about seasonality. Here's the S&P versus defensive stocks. So I find this interesting. This is defensive stocks versus the S&P. So when this ratio is down, what that means is that people are not investing in defensive stocks. It means they're not cautious. When it's up, it means people are cautious, right? So the dates didn't transcribe in here. Apologies, but basically, right now the market is not investing in defensive stocks. They were here. This is this year. So this is April. So this is April after the tariffs. People invested in defensive stocks because they were trying to protect themselves. I'm sorry. Wait, this is anyway. Let's just. Actually, sorry. This is the year's not in here. I was kind of screwed. This is 2000. So my apologies. But if you look at this, just compare this to the S&P, and you'll see there are times where it spikes and it drops. When the market drops, people tend to go to defensive. When it tops out, it tends to be low. So right now it's kind of low. It's close to the recent not all-time low. I think this is the 20. This is probably a 40-year chart. I think, come to think of it, this is the 2000s. So this is a 40 or 50-year chart. So if you look at this, this is the lowest it's been. So you want to be careful. This is you want to be careful time because people aren't investing in defensive stocks. Poly markets, 4% chance of recession this year. Not sure I buy that, but I think it's interesting. Construction spending has stalled. Housing's 20% cheaper. I'm going to let Doug talk. I just wanted to run through these because they're interesting.
You can go ahead and
Okay,
have the chart.
last
So
one, nuclear stocks. This is just a list of nuclear stocks. Just something to keep in mind and how they've done this year. I'm not saying you should invest in these. I'm just saying here's a list of them. So those of you who are audio viewers, go on YouTube or go on our website and get a list of these as well as the other charts. So why don't you kind of wrap us up, Doug? Final thoughts here. And
well, on this chart right here, I am going to caution anybody from ever investing in PG&E. The nightmares of the regulations that PG&E has to deal with in California. Yeah, and the number of times that PGE has gone bankrupt because of regulatory adjustments there, just it is definitely an endless headwind that they face. Look, as a retirement income expert, I want to come back to the conversation around the private wealth because that one's certainly fascinating to me today, and it's definitely fresh in the news. We're going to see what's going to happen with the Big Ten. The bottom line is protecting your wealth isn't just about how much you built; it's going to be how you structure it to last. And if you look at those headlines, like even the Big Ten with the billions in brand value, it is being tempted right now to pawn off its future for a private equity cash today. And that's what happens when you chase short-term liquidity without thinking about long-term sovereignty. The same thing can happen to you individually in your household wealth plan. And too many affluent families are going to assume that their net worth is just going to absorb things like college costs. And that's going to leave tuition money exposed in the field, the riskiest part of their portfolio, right up until the bill arrives. And when those markets tumble, Kirk talked about consumer defensive. You know what? People like to jump to them after the market tumbles. And then you go to the one thing that generally doesn't recover and spike because we've talked about this last couple of weeks. You're jumping into it after the trend. And when you want to get there before the trend. So once those markets stumble, that tuition bill can double in real cost, and all of your other expenses can double in real cost, and also quietly erode the retirement income that you thought was untouchable because you now have less, and you often make very critical decisions at the most emotional time, which is the most dangerous thing you can do. That's the financial version of selling tomorrow's seed corn for today's harvest check. It is short-term relief and it is long-term regret. So the real danger, as I've stated before, is not the risk it's the risk you don't see ahead. Over and over, retirement income scenario testing has shown that retiring into a known downturn is less damaging than being blindsided later. It's not the storm you see in the rearview mirror. It's the one hidden that's around the next bend that's going to wreck your harvest. The Big Ten may not feel the cost of its deal for decades, but by then, the damage is baked in. And a school like Ohio State, they may just jump, right? They've got the power and the equity and the branding. They can say, you know what, Big Ten, you kissed your future. We're going to go join the Alabamas of the world and the Georgias of the world. We're going to create something different and leave you in the dust. That damage, once it's soaked, once it's baked in, listen, don't let that be your family's financial story. You're not in Ohio State. You're not in Alabama. You can't just jump and leave if your world collapses in dust around you. Okay. So you've got to make sure you're thinking and asking yourself, are you still planning college and retirement with yesterday's playbook, assuming the markets are always going to cooperate? Or maybe you're one on the defensive side and you're sitting there in cash thinking, oh my gosh, I just got to prepare for the worst. And you're sitting there just waiting and waiting and losing opportunity for a time that it may not come for years. Are you building a structure that protects income and tuition dollars from unseen risks that can derail both? If your gut is telling you that something's off, you need to trust it. You also need to be early to the trend of smart money. If you want to know how that is going to happen and lay the process and put everything in a well-working order in all of your financial life, visit our website, mergentadvisors.net. That is MERGENT, mergentadvisors.net, MERGENT, or specifically around how college planning and the amount and the money that you can save and the tax strategies and just being a smart money family around college, not just writing after tax checks that are blowing your money and your future. Check out mergentcollegeadvisors.com. Let's build a plan that will shield you both your retirement income and your family's education capital so today's college bills don't become tomorrow's retirement shortfall.
Awesome. Well, thanks for joining us, Doug. I actually have two quick things I forgot to mention, which I thought were really, really interesting. So, one of which is I was just reading this 39% of institutional investors have 0% in gold. 39% of institutions have 0% of their allocation in gold. What do you think is going to happen when they decide to put some money in? I find this interesting.
Those early to the trend are going to thank them.
20% have 4% in gold, 16% have 2%, and then 8% of 6%, and 6% of 8% or more. There is so little money in gold right now, and that it's kind of like Bitcoin as an example, where the institutions weren't in because they couldn't buy ETFs and blah blah blah. They come up with some reason. Uh, Advisors put like 1% of your account in Bitcoin. There's so little money in cryptocurrency right now from an institutional perspective, from an advisor perspective. Same thing with gold and silver. There's very little money. It's coming in, but I remember when I started, like back in 2017, when I was putting some clients in Bitcoin because it was a closed end fund, and I think I put like 1%. Like I didn't, it was risky. I didn't understand it, and I was like, oh, I'll put 1%. Like this, I think I understand it well enough, and I like the direction, and let's try it. It was 1%. What could go wrong? You lose 1%. That's like a daily movement in the stock market. So it's not a lot, right? It's very small. But it wasn't enough because it went up 1,400% that year. It was crazy. And we didn't get all that, by the way. We got out way too early. But my point is when you start into something you don't know, you start small, right? So gold investors starting small. At some point, we talked to, there's a few guests in the show I talked to off air. I didn't want to ask them on air because they wouldn't tell me. But off air, they told me like one of them has like 25% of his account in gold. 25%. This is a year ago. He's doing pretty well. There are allocations that have 25% in gold. The permanent portfolio, for example, famous permanent portfolio, very well known, 25% gold. That's the stipulation in there. So my point is you have gold is 39% of them have 0%. At some point they'll come around, just like they're coming around with cryptocurrencies. So what's going to happen? That's a whole bunch of new money coming in the market that's not there, and they're not even scratching the surface. Gold's going up 50% a year. You think they're going to stick with 0 or 1%? No, they're gonna increase that. Anyway, I want to state that. I also want to state something I just learned this week, which is awesome. Which is if you have a 401k, you've got money in there, and you want to take it out, but you're not leaving your job, but you just don't like the plan. The plan's horrible. You got a lot of money and you're like, oh, I hate the plan. I want to invest in something else. I want to invest in, alternative assets, or I want to invest in this. I want to invest myself in the stock market. And my company has really terrible options. I found a way you could potentially get it out of there without causing problems at work. I'm researching it. If you're interested, you can give me a call. I'm easy to find. And I can tell you that it's a really interesting pathway. We have a lot of people looking for alts with their retirement accounts, and I can tell you it's fascinating. So if you have an interest, let me know. That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, wealth manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.